Well, it is Jobs Day here in the market. Welcome to Friday, December 8th. We get the much anticipated BLS jobs report, and the theme from it is one that my kids will know from a Rolling Stones song. You can't always get what you want. We were hoping for a much more muted report than what we got, but it still wasn't bad. It came in a little bit hotter than expected. Let's go through all the details here and get you caught up. So the the business report, which is the headline report, showed that there were 199,000 jobs created. The market was expecting 190,000, so a little bit hotter than expected. Now, not surprisingly, there was a revision to previous month, which we've talked about. We're expecting revisions here in the future because we just don't trust this BLS report. The downward revisions to the previous months, which was September, was a minus 35,000 jobs from that September report, which was the super hot report, which brought us those wild 8% mortgage rates. So that was revised from 297 to 262,000. Now, what's interesting on these 199,000 jobs, 47,000 of them came from UAW workers returning and from Screen Actors Guild returning from the strike in California. Now, I just really don't agree with this. How are these new jobs? These are people returning from a strike. They're not new jobs created, they're existing jobs. So I really have concerns and issues with what these numbers are showing. And the birth death model within the BLS was a little bit better this month. It added 4,000 jobs. So what really wasn't a significant impact on the report. That's always the big variable. Now, the things that did affect the report and how it's treated in the market today is average hourly earnings, which is a measure of wage pressure, which is a significant thing that the Fed is watching. The wage pressure inflation rose by 0.4%, which was a tenth hotter than expected. Year over year, the average hourly earnings now remain flat at 4% because the previous month, October, was revised downward from 4.1 to 4%. But this 4% year over year reading was expected and shows that wage pressure is now starting to get under control and become flat or decreasing. This will significantly help the Fed in decisions going forward with potential rate cuts. Average weekly hours worked rose from 34.3 to 34.4, rising from their bottom point, which was April of 2020. Average weekly earnings rose 0.6% and is now up 3.7% year over year, which is an increase from the previous month of 3.2%. Now, the household survey is where they actually physically call people around the country and survey them for the information versus the business report. The household survey, which does show what unemployment is, has its own job creation component, and it showed 747,000 jobs created. Kind of interesting and a surprise. And the labor force expanded by 532,000. Now, what that did is it brought in unemployment from 3.9 to 3.7%. We were actually expecting unemployment to be flat at 3.9%. So did affect the bond market in a little bit. So the trend in job growth is still clearly lower when considering the weak ADP figures. In stark contrast, the drop in job openings, those that said it's harder to find jobs, are rising to the highest level since 2021. Weak manufacturing, which we saw yesterday, employment and job listings continue to decrease from everything from the JOLTS report to the Challenger job report to ZipRecruiter. So in our mind, we are definitely showing that trend line of a weaker employment market. Now, what that did is opened up the mortgage-backed securities are down 19 basis points as I'm looking right now. 10-year Treasury is up 12 to 4.24. It's the highest in about a couple, 3-4 days. But if we would have gotten the same report a couple weeks ago, I think we would have had a more significant impact to the markets than what they're seeing in this. So we're getting through this report and without a significant amount of damage, which is great news. Now that leads us into next week. Next week is such an important week. I think this is going to be the telling of what's going to bring us to the next, 3-4 weeks, getting into the first quarter of next year, and whether we're going to be on that path to rate cuts in the March meeting. So Monday we have a 10-year auction, which is very important. We've seen weak demand for bond sales, so we're going to really look to see what the demand is for that 10-year auction. Tuesday, CPI inflation reading, very, very important. And then we have a 30-year bond auction. Wednesday is going to be the wholesale side of inflation, PPI, and the Fed rate decision. Now, nobody is expecting them to raise rates. The big part will be, what is the Q&A and commentary going to be from Chairman Powell? Is he going to give himself some rope to game the markets a little bit, to give them an out if they need it? Is he going to come in a touch to the hawkish side when really the data isn't showing that? So we're going to wait to see. We're going to wait to see what happens with that, how the market digests what he says. And then it doesn't stop there. Thursday, we have jobless claims and retail sales. So there's a whole lot going on. Next week is just really critical. If we can sustain ourselves, get a little bit of momentum back, we can get even better on rates. That's going to take us into the first quarter, I think, in a much better place than where we were even 3 weeks ago. And we're going to be on a great path. And I think that path will lead to potentially rate cuts by the end of March by the Fed. And that's going to bring all the buyers in the world back out. We've talked about it. Don't be, ride the wave. Don't be on the bottom being crushed by the wave of buyers. Give us a call. Let us help you get pre-approved this weekend. We're working. We're available. 616-293-2189. Let us help you get pre-approved and get in a house and beat all that competition that is on its way. We hope you have a fantastic weekend.